Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Brendon Murphy, who's the CEO and President of Compass Financial Solutions, and we'll be talking about personal pension approaches with fixed index annuities. Brendon, welcome to the program.
Mike, thanks for having me back.
Hey, you're welcome. And I think that a lot of times people hear pension. Nobody gets pensions these days. Well, we're talking about a personal pension. So I'm excited to hear how you serve your clients that way. Let's kind of define actually what is a personal pension.
So a personal pension is just exactly like it sounds. I mean, if you remember what your grandparents had, and maybe you don't, but they worked for a company for a certain amount of years, and at the end of the day, the company paid them for the rest of their life and left a little bit over for the missus. So the personal pension these days is really just taking your own dollars of some sort of IRA dollars at the end. You have a 401k, let's say it's worth $1 million or $500,000. You take a portion, say 200, and then you're going to roll that to what's called a fixed indexed annuity with a lifetime income benefit rider. And then it's going to pay you for the rest of your life an income stream that you can't outlive. And then the rest of your money you can reinvest into the market or whatever you decide you wanted to reinvest in. But the number one part about the pension is that you're getting guaranteed income.
I love the word guarantee, and I want to go a little bit deeper on that, but also something you just said too. Income you cannot outlive. Well, I think one of the big fears that people have in their mind is, I need to save X number of dollars because what if I retire here and I live to X and I need to have enough money? Well, how could you say you'll never outlive this from this type of annuity?
Right. So it's a contract between you and the insurance company. So client A, insurance company. What happens is that whatever dollar amount you invest, they use that money to give you a percentage, a payout percentage is what it's called. And it's based on your age, right? So let's say you're 65 years old. Your payout percentage is 5.5%. And the value of the annuity is $300,000. You're going to take that times the 5.5%. They're going to give you a yearly income that you can get monthly, quarterly, or annually. And they're going to pay that every year for the rest of your life. And that's what's called a fixed indexed annuity with income benefit rider. So they'll pay that either single or joint, just like a pension would if you received it from a company. So for 50 basis points, so if I said 5.5%, so for 5%, they'll pay that to you, and then they'll pay that to your spouse for the rest of their life as well.
You know, in life, there's not many guarantees, death and taxes. That's funny. But when we start getting into guarantees in money and income, and you can't lose principal, and here's a guaranteed income of X percent and a guaranteed income stream, that's huge, because I know that a lot of people go, I'm just going to pop out 30, 40 grand out of my portfolio. Well, if you still have it in the market and you're taking out that amount of money, what if the market was in a downturn at that moment? Well, now you've taken money out and it's at the lower rate, and now that creates a whole avalanche of other issues. This is a powerful concept that I think a lot of people don't even realize is available.
Yeah, I think they missed on that. So if you go back to even 2008, and people lost 50% of their portfolio at the time. Mm-hmm. Well, they were taking money out of their account. Say they were taking $40,000, and you just lost 50%, and then you're taking the 40 on top of it, right? So if you had $1 million and you lost 50%, and now you're taking 40 grand because that's what you have to live on. Well, what if we replaced that 40 grand you were taking out of that account and we put it into a fixed index annuity? Well, that would continue to have paid you that $40,000 of income while the market over the next 6 years was, coming back. Okay. Yes. And the same thing even now, even in the bull run, if you had taken some money out of the 401k or out of the IRA, if you left your job, 401k, you rolled it to an IRA, and then you put some of that money into the annuity, you're taking your guaranteed income. You had reinvested the rest of the money inside the market. And on this bull run, you've already made back what you put into the annuity, and you're living off the income. Now you're even more far ahead, right? So if you want to start pulling off the money in the market, you're ahead of the game.
That's huge. And I know that and I think that a lot of times people don't really get understand the level of what you just described, because it's like, wow, you can never time what the market's doing connected to when I need my money. And even if the market went down a little bit, they're like, oh, well, now I need to recoup that. And it just is a big a domino effect. But when you have a nice percentage of your retirement income into these type of accounts where it's like, it's never going to change. You don't need to worry about it. It's never going to drop. You're going to get this amount and this amount per month or quarter or year in income. To me, that's a big, huge peace of mind aspect.
For most of my clients, it is. I mean, most of our clients are saying, hey, we've made some really good money these last couple of years. We want to protect some of it now, right? So they're coming and having conversations about annuities because they know that they protect. Whether you invest $1, $100,000, or $1 million, market goes down. You don't lose any money of the principal inside the annuity. If the market goes up and you're participating in whatever indexes are inside, say S&P, say Russell, and it goes up 10%, and now so $100,000 you're at 110, that's your new principal. So the next year you're at 110. The market goes down, you didn't lose anything. The year after that, market goes up again. You're not waiting for the comeback. You're starting
at the 110.
You're starting at the 110.
Yeah,
absolutely.
But what if the market crashes and everyone in your circle of friends is going, we lost 20% of our portfolio, and you just go down to zero? You just didn't make any money, but you certainly didn't lose it. That's a huge position to be in.
That's a huge position to be in some type of recession, and then you can pull off of that to take income from that bucket while the rest of your assets are growing or trying to come back. So you have flexibility by using the annuities in retirement planning, especially in that fixed asset portion of your either IRA or 401k, whatever it may be.
Yep. So I think that when people, you say, hey, what is your first thought when you hear this word? I think if people hear the word annuity, they think, red flag. Sometimes. What are some of the misconceptions that people have about annuities from years past, and now how have they changed to where maybe they're not that way anymore?
Right. Well, there's multiple types of annuities. So when you hear this, you hear something bad, it might be that you associate the fixed index with the variable annuity. So the variable annuity, that gives you some guarantees, but your principal goes up and down like the market, but it can pay you a guaranteed income stream. The fees are also high in the variable annuity. The ME costs, life insurance costs, it could be like 4.5%. So you make 5%, you're paying 4.5%. You only made 1% in that annuity. So a lot of people get misconstrued between the fixed annuity, the fixed indexed annuity, and the variable annuity, because usually those are the most common annuities that are out there. So those are misconstrued. The other part is that your principal's locked up. Yes. You could take a percentage withdrawal every year that the contract's there, or some of these contracts have what are called liquidity riders, where you could get, if you don't take 10 in the first year, you take 20 in the second. So really, if you're looking at fixed income and you're trying to guarantee principal, you're not really taking it in the first couple of years anyway. So it just depends on who you're having a conversation with, what advisor you're talking to, and what is your plan going forward to use the annuity. Because if the person across from you tells you exactly how it works, where it works, how you take the withdrawal, you'll never have a problem. But if you don't,
because if you had X number of dollars and you needed it in a year or two, then you're not going to lock it up in any kind of an account.
No.
So call it annuity or CD. You're not going to put it into a 5-year CD if you needed it anyway. So it's kind of like know what you're getting into, know what you need anyway. So maybe that misconception was really amplified by a bunch of advisors giving bad advice in decades past.
Yeah, and at the time, I think, and then they were put on like income riders when you didn't need the income, right? So nowadays you have products that you can use, whether it be a 3-year, a 5-year, a 7-year. You have different products you can use that have all different kinds of mechanisms inside of them, and depending on what you need. Do you need an ADL benefit? Do you need an excessive death benefit rider? Do you need lifetime income? Do you just want a guaranteed fixed rate of return? Unlike a CD, right? So a CD, you put it in for 3 years at, say, whatever that rate is, 4%. You're taxed on that every year. But you can use what's called a multi-year guaranteed annuity for 3 years, get 5%, and then you only pay the tax when you take it out. And you can just keep rolling it along the way. So you have multiple options. Annuities have fixed interest accounts. They have S&P accounts that are either a cap or a participation rate, and that's how you make your money. And we can get into that at a different time. If people have questions, they can ask me. I would gladly explain it. But you have a floor and a ceiling. You're never going to get 30%, right?
Yeah.
Right? You're not going to get 30, but if you can get 20, and then if the market crashes, you made 20, but you didn't lose anything after that, that's the give up. You're just not going to get that 30.
Yeah, but the benefit is you've got that floor to protect you.
Right. So that's the give up, right? Hey, I'm going to give up the 30 to have the floor.
Yes.
And at this point, if you're from 63 to 75 and you're getting ready to retire, you need a floor. You need a floor because you worked hard for all these dollars. You don't want it to be taken away just if the market does take a little step back. And don't get me wrong, the market will come back at some point, right?
Yeah.
But Goldman Sachs just said at some point, the S&P can only do maybe 3% for the next 10 years. They're calling it the last decade. Well, what if it's not running at 7 to 10% historically like it is, and it's only running at 3? You might want to have some guaranteed income to make sure that you're protected going further down the line. And that's just one example. But I just read that the other day, so it kind of just stands out.
I want to talk a little bit more about something you mentioned, some of those added features, like long-term care. And so talk a little bit about some of those other living benefits types things that in reality, I don't know your business, but I've never thought of those kind of benefits being associated with an annuity. I always thought you have to go get a policy for this and another policy for that. So talk a little bit about now how some of these kind of are enhanced benefits.
Yeah, so you're putting money in, and I'll look for the ADL benefit. Let's use the ADL benefit. If you can't perform 2 of the 6 acts of daily living, okay, the policy will pay out over a 7-year stretch monthly to you, and then if, God forbid, you pass away, it will pay to your spouse for the rest of that time. So all the dollars will be used to help pay for your care while you're getting it, whether it be at home or wherever you may end up, adult daycare, nursing home. But if you couldn't get some type of long-term care, this ADL benefit, because it's not long-term care, it's ADL, like actual, you can't perform 2 of the 6, you could turn on this benefit. As long as you let this, we're going to be prepared, and we're going to do it a couple of years, before, while we're healthy. And if, something comes up, it pays out a benefit. You also have what's called an excessive death benefit. So most of the times when you pass away and you have an annuity, the cash value goes to the beneficiary. Okay. And in this situation, you can either take the cash value of what it is or get a payout higher if you take it out over 5 years. So if it's IRA dollars, which this would be helpful because of the rules, the Secure Act 2019, you have to take it out over 10 years. So if you took this excessive death benefit, you would actually get more money than the policy actually had in it because of the benefits that were built inside those policies. Okay. So
that's huge.
That's huge. And then guaranteed income, if you have a spouse and maybe your spouse didn't make as much money as you did, but you have a large bucket of IRA dollars, you could turn that IRA into a guaranteed income stream that you both can't outlive. And then still leave whatever's left in your other assets to your spouse and to your kids. So if you can use these vehicles to kind of check boxes along the way to make sure guaranteed income, your income in retirement is where you need to be. Besides Social Security, which Social Security is an annuity. It's a personal pension that the government controls, but it's paid out like an annuity. And then if you have your own personal annuity or your own personal pension, just to make sure that your income's there where it needs to be.
So here's a question for you, and I'm always one that as I'm talking and learning from people like you, it makes me think of, how would this work? So let's say that someone hears, okay, annuities, they've got some great power. I'm not 75, I'm 55, so I'm going to get an annuity, but I don't need an income stream right now. I don't need to have that, coming back. Can you get an annuity and just set it up for returns now, and then when you need the income in however many years, you switch it and go, okay, now I don't need the return side, I need the income side.
Yeah, we just did that with a couple clients. So we just came on. We had a couple college professors in their early 50s, 52. They're looking towards retirement but want to protect some of their assets. So we looked at a 5-year fixed indexed annuity. So it has a fixed bucket of 4.5%. right now. I mean, those rates they change all the time, right? And then it has S&P, it has InvestQ index in it, it has NASDAQ in it, but it's a 5-year product. So for 5 years, we protect those dollars. Whatever the interest is in the indexes, that gets locked in every year. That's called the annual reset. At the end of the 5th year, they have the option to move it to wherever they want, whether it's move to now an income, because now at 52, they're 57, they only have, they want to retire at 62, or they can stay what they're doing, or you find the next thing that's giving you a better fixed interest rate and better option rates at the time, and you move it again. And then we wait it out. Hey, I'm going to push off 62. I'm not going to retire to 66. We want to be closer to, by then Social Security made the 70s, but either way, it's more of like, hey, we can keep pushing this off right now. And then, you have flexibility.
But then you don't lock it up for 9 years when you know you might need it in 5. So in that scenario, you did like the 5-year now, but then in 5 years, you might go, oh, you know what? Why don't we put it in a 3-year product, because we don't know, we don't want to lock it for 5, 7, 9. So it just all gets into planning. And I think that misconception from years past, like, oh, it's locked up. Well, right. But you just lock it up for a time that fits your needs.
Correct. Because you're not, so like it's the same thing if you were trying to take money out of your 401k or IRA. If you're under 59 and a half and you're at 55, you don't want to pay that penalty, right? You can borrow from your 401k, but you're not going to rip money out of your IRA because you're going to pay the taxes plus the penalty. It's the same thing with the annuity. But when you hit 59 and a half, same thing as your IRA, you can take money out of it.
Yes.
If you have qualified dollars, you can take, mostly every annuity, regardless, after the first year, you can take 10%. And I'm telling you, if you don't take 10 the first year, you get 20 the second year. It just depends on the companies you're working with.
Yeah.
And when I do a business, I'm only looking at A-plus rated, A-rated carriers and above, the A-plus, because they always have the feature in the renewal rates that make sure that my clients stay where they're supposed to be and make sure that they're earning what they're supposed to be, right? Even in a down market, if we're in some type of fixed bucket, you're going to get some kind of fixed return on what you are. And if the S&P only does 7 and we're in the, if the S&P does 3, we're going to make sure that you make some of that S&P money, right?
So here's an observation. You always hear about, oh, let's do an annual review to make sure. Well, if you hear annuity, fixed, guaranteed, you might think, oh, I don't need to have an annual review. But now what you're saying right there makes me think you might need to just have a quick little cursory check to make sure that, the S&P this and the fix that, to make sure that the annuity itself is in the right spot for you. So have that annual checkup.
Well, because also what has changed in a year? You could need money. You might have to dip into that money.
Yeah.
So everything's changed on a daily basis for people.
Yep.
Right? The plan we put together today might not be the plan 5 years from now. Right? So everything changes in people's lives. Like, oh my God, I had to tap into that earlier. We just had a client that we've had for years. Her husband died unexpectedly in the last week. And she's like, I don't want to tap into the annuity, but I need money until the insurance money comes in. No problem. That wasn't part of the plan. Her husband dying at 62 wasn't part of the plan either. But you just sit there and you're going through it and you go, what do you need? How can I help you? I need this. We can do this right now. We did the withdrawal. It'll be there. It's there in 2 days in her bank account, and everything's covered that she needs to have covered until we help her with the process of filling out the claims for everything else,
So the bottom line, don't try to figure it out on your own, and have someone sit down with you to put together a plan that works, and then don't just set it and forget it, because life happens. Your needs change. The markets change. Whatever the case is, come in for that annual review just to give it a quick checkup, thumbs up. Okay, we're still good to go. Oh, you know what? 1 year we need to make this tweak. I think that too many people are so self-sufficient. They think, I'm going to Google this, set this up. But did you do it the right way at the right time? And then you need to just make sure that you've got those.
Mike, one other thing I just remembered. If you purchase an annuity back in the day, like say 10 years ago, and it's just sitting there, call someone. You can call me. You can call whatever advisor you want to talk to. The rates that they were then, compared to what they are now, you're doing yourself a disservice by not having someone review that.
Wow.
Okay.
Yeah. And that's a really great point, because guess what? That happened to me. and it was like. It was like double the rate of return. So that's an excellent point. I'm glad you thought to bring that up, because you might go, oh, yeah, I don't need an annuity now because I've got one. Check the box. Well, give it a second opinion, because what if it is something where it's like, oh, well, we'll just file a piece of paper, move it from this fund to that fund, or this company to that company, and you're going to now double your rate of return, and it's just sitting in a fresh annuity. Have someone look at it. That's a really, really great point.
We call it the retirement reset. You did it because you did it for a specific reason. We'll make sure it's doing what it's supposed to do. And if it's just sitting there, give us a call. We'll make sure that it's doing what it's supposed to do.
Awesome. Well, if someone is in that situation, Brendon, how can they reach out and learn more and connect with you?
They can reach us at 610-449-9900. That's our office. We're on the Compass Wealth podcast on iHeart and Spotify. And then our website, mycfsi.com.
Excellent. Well, thank you so much for coming back on. It's been a real pleasure talking with you.
You also, Mike. I really appreciate you having me on again.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.